tech and climate. More than what you need to know, it's what you need to think about.
Since the beginning of this year, there has been increased volatility in the international landscape as geopolitical conflicts erupted one after another. Global economic recovery, fragile as it was, has now come under greater strain. Against this backdrop, China's economy got off to a good start. It withstood the challenges, forged ahead, and demonstrated stronger resilience and a promising outlook.
Chinese Premier Li Qiang telling the WEF meeting in Dalian that the world's second biggest economy is maintaining sound momentum. We will speak with an advisor, though, later to the country's central bank, who is warning of risks to growth unless more is done to boost domestic consumption. Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, we've got a cautious rebound from a tech-led stock sell-off. That's now fading as losses in bellwether chipmaker TSMC weigh on Asian markets. The volatile backdrop sharpening the focus on Micron's results, which are out later, as the next indicator on the strength of the AI rally. And we are live at the WEF meeting in Dalian to get insights on business sentiment in China with McKinsey's Ngai, who argues the country is now a premier innovation ecosystem and not just a low-cost factory hub. An advisor to China's central bank says a rebalancing of the domestic economy is a crucial next step. Huang Yiping joins us to discuss policy stimulus and share his thoughts about the yuan's valuation. Also, AI in focus as we speak to the co-founder of global cloud platform Tuya about deployment and commercialization of AI hardware. Chinese Premier Li Qiang has just ended his speech at the World Economic Forum in Dalian. He says China remains committed to opening up in a world that's growing increasingly protectionist, and also praised the state of the Chinese economy, saying that it has shown resilience in the face of global turmoil. Let's get to Bloomberg China correspondent Min Min Lo now, who is at the event. Min Min, tell us about some of the other key takeaways.
Yeah, this has been a 50 minutes long speech and one of the more frank and engaging speeches I've heard from Li Qiang of late. And he was really hitting back at a number of foreign criticisms of the Chinese economy, particularly when it comes to tech. We know, for example, the US tech firms have been accusing Chinese AI firms of distilling their AI models. And he specifically talked about how it's impossible to copy your way to an innovation edge. And he says that China's tech resilience really is forged through painstaking development. And he talked about how China's R&D expenditure has risen by 10% a year annually between 2021 to 2025. He touted the example of Huawei and how they spend more than 1 trillion RMB over a decade. That's how they reach and achieve those breakthroughs. It's not from copying. And he also said it's not from the government subsidies as well. He said, to be honest, the Chinese government doesn't have enough money to give out all of that subsidies. And that comment drew some laughter from the audience there. And he also made a very strong sales pitch about China Opportunity 2.0. And this was directly challenging the idea that's floating out there by certain media, talking about the China Shock 2.0. So he said that should be reframed as China Opportunity 2.0. And he talked about how in China, the tech ecosystem is so deeply embedded, and it's very easy to take an idea from the blueprint to prototype to production to taking it to market, and you embed that with that 1.4 billion strong market. That creates a closed loop where you can quickly test and prototype new products, and then you feed that back into corporate R&D cycles. So he talked about that. And the other thing he mentioned as well, of course, is China's stability. We know that China's GDP growth in the first quarter is 5%. He said the momentum is still sound in the second second quarter. That is despite we saw those economic data last week showing retail sales contracting for the first time in years, and Goldman Sachs lowering the growth forecast for China. I'm not sure how people are convinced about his comments there because of the data showing otherwise, but he's saying that the trajectory is seeing sound momentum when it comes to China's economy.
Yes, in terms of the sluggish Chinese economy, there are definitely sections that are struggling at the moment. Is there enough here for markets and investors to feel reassured?
Well, he said that the Chinese government will continue to invest in infrastructure. So he talked about telecommunications infrastructure, power grid, data centers, interconnected ones across the country. So those are infrastructures that would be very supportive for enterprise development, especially those that want to really tap into that AI boom and tap into that increased usage of electricity. So that is one, and that certainly addresses some of the concern as we see the fiscal deficit shrinking earlier this year, concern about government spending slowing down. In terms of fiscal stimulus to boost domestic consumption, though, he didn't really give us any sign that China is going to inject more stimulus on that front. So I think that's not enough to convince people about whether or not consumption is going to see a pickup, even though he really sold the idea of the dynamism of the Chinese economy and how there is rich diversity and high growth potential for Chinese domestic demand. We know, of course, that Chinese consumers have very high level of savings, very low debt rates. The question is, how can foreign companies really attract these consumers to unlock their bank savings?
All right, Bloomberg China correspondent Min Lo at the WF there in Dalian. Well, a rebound in Asian markets is now fading after Tuesday's tech-driven sell-off as we head into the next big test for AI sentiment, of course, Micron's earnings. Let's get the latest now from Hong Kong with markets reporter Anthony Stevens. Anthony, we did have the Kospi putting up something of a rebound, but we're in negative territory now. What is this telling us about the enthusiasm or lack thereof of dip buyers, and could we expect to see a more enduring rebound?
Yeah, just before you went to air, Korea just fell off a cliff, right? Hynix is off around 8% from the highs. It's a pretty sharp sell-off, and there's a characteristic lack of kind of any big news flow driving this volatility. Intraday volatility in Korea has picked up materially. We've had multiple days of over 5% intraday swings. Now we're on our third day in a row. B Kospi is in the 90 handle, which means that Kospi has to realize at least 5.5% a day for just the implied volatility to make sense. So volatility is very high. Today's intraday sell-off is being attributed to comments from the Korean policy officials around sharing the gains from the AI boom. That has to be substantiated, and it'll probably get more detail as the day goes by. The local retail is very long and very nervous going into the Micron earnings. Micron moves typically 5 to 6% a day after earnings, and this time it's carrying a 10% implied move into earnings. So quite significant. I said before that B Kospi trades at a 90 handle. Micron implied volatility is at a 100 handle. So there's a lot of volatility in the tech space. There's a lot that needs to be revealed from the Micron earnings in terms of the sustainability of earnings. There's been a lot of debate around the fundamental underpinnings of the memory trade. Is demand for HBM memory, high bandwidth memory, unlimited, or has it reached a point where consumers are pushing back on the cost of this memory, and are people switching back to the cheaper DRAM? So there's a lot of fundamental concerns underlying a very volatile and a very liquid trade here.
Yeah, considering the tech-heavy nature of the Kospi and the massive run-up that we've seen this year, it's easy to forget sometimes that it's still classified by MSCI as an emerging market. So what reforms are still needed to change that? And Indonesia's having a bit of difficulty in that regard as well.
Yeah, this comes back down to the microstructure. So Korea might be a very advanced economy with huge size and technological sophistication, but it does retain some aspects of an emerging market when it comes to its FX and the execution of trades. And this is what MSCI is focused on. So the Korean FX market is heavily managed. It does not trade 24/7, and it still trades more or less in NDF form. That makes it very difficult for global investors to hedge their FX risk from equities. That is one aspect. The second aspect is, it's very easy to buy Korean equity. It's much harder to short Korean equity. And the technicality around how easy it is to short Korean equity versus, say, a developed market like Hong Kong, Singapore, or the US is significant still. So the MSCI has asked Korea to continue on this path of financial reform. Now, it's important to mention that Korea was one of those markets that was very heavily impacted by the Asian financial crisis. So how much of that control they want to relinquish in becoming DM is interesting. For Indonesia, on the other hand, Indonesia needs to continue to reform to stay in emerging markets as the standard for emerging markets keeps moving higher. For example, China, India are very sophisticated equity markets, even though they have controlled currencies and controlled short selling. So Indonesia needs to keep running to stay in place, having a very different set of challenges from Korea here.
Well, we also heard from Li Qiang, the Chinese premier, a short time ago. Pretty long speech. He was quite upbeat on the Chinese economy, but Chinese stocks in Hong Kong not feeling it. Why is investor sentiment so weak there at the moment?
Well, his speech speaks to the essential dichotomy of the Chinese market, right? Depends on which market you're looking at. The Asia market is actually flat on the year. The Chinex is up a lot, but HS Tech is in a bear market. And that speaks to some of his comments, right? That Chinese technology innovation is very, very strong. And investors are rewarding that in the growth stocks in the Chinex. And today specifically, during his speech, Chinese semiconductor names are very strong. They're up around 15 to 16% amidst a regional sell-off in the semiconductor space. So China is innovating in certain segments of its economy. On the other hand, the Chinese consumer economy continues to struggle, and without higher consumption, they cannot turn the corner on these big cap China internet stocks. These big cap China internet stocks are basically a play on Chinese consumption, and unless consumption changes, the direction of travel will not change. Now, one positive headline on the margin is that these China internet stocks are introducing AI models to their consumer applications to try to marry those two worlds. But it still remains to be seen whether that strategy works out in the long run.
All right, Bloomberg Markets reporter Anthony Stevens there. And we have more ahead from the WEF meeting in Dalian. McKinsey's Greater China Chairman Joe Ngai is going to join us next to discuss the business environment and why underlying tensions over trade and technology remain unresolved. This is Bloomberg.
The IPO market is getting unclogged, if you will, is certainly helpful in terms of exit. So exits will be important, but I think new investment opportunities will also be important. I think the fact that there is a détente makes, I think, at least a near-term outlook a little bit more stable.
We have R&D hubs around the globe, but China is going to be really based around software and automation. And there's this notion of labs becoming more autonomous or more AI, physical AI ready. And that's where we feel we really want to be at the heart of the innovation here in China.
When the token cost becomes so expensive, people look for solutions. We have 40 million vehicles, EVs, in the market. If you think about multiplied by that the power, the energy power and computation power, that's a huge resource. We will tap into that.
Some of our guests there at the World Economic Forum in Dalian talking about doing business in China. And let's get back to Dalian now, where Min Min Lo is standing by with our next guest, who helms McKinsey's management consulting practice in China. Min Min.
Hey, Paul, thank you so much for having us. We have Joe Ngai here, as you said, the Greater China Chairman of McKinsey. Thank you for joining us. Great timing right after Premier Li's speech. You were inside the plenary. He was really selling this idea of China Opportunity 2.0 instead of the China Shock 2.0. Do you agree with that?
Well, first of all, I think it's very interesting to see Premier Li because I think in the last couple of years, I think he's been quite consistent around what he's saying. Right? He wants an open market. He wants more multinationals to collaborate with China. I think that he also spent some time today talking about consumption in China and around how he sees a consumption revival right in China as well. So I do think that he's touching all the right points. But obviously, he spent a lot of time talking about innovation in China, talking about technology in China and how that can be a force for good for the world. And one of the things that he's stressing was that, well, we all have growth problems, but innovation and China R&D and China inspiration can be part of a solution for the growth, right, for the world. And I think that is a good way to actually position China in today's theme, especially here at Summit Davos.
I remember you have previously mentioned how China's lead in autonomous driving in robotics is undisputable, especially in the tech area. But some might dispute that, especially when it comes to the hardware side, the chip side. What would you say to that?
Well, I think that right now, every country is thinking about themselves a little bit, right, around security, around resilience, and all that. So it's natural that everyone's thinking a little bit around, well, like I need my own, right, industrial as well, right? I need my own industrial policy, my manufacturing. So the question then, therefore, is, well, China got its strength, but what does that mean for me? And one of the things that I've been saying is that I think, China used to be a factory for the world. I think in the next days, China can be the factory for factories, right? Because every country wants to have our own factories, but China can be the factory that provides the factory, right, for the rest of the world. So, in some ways, I think China could be part of the solution to the industrial competitiveness of many countries around the world as they think about their own resilience.
Well, I think many companies will want to be in China and will want to participate in that development story, but the risk, the geopolitical risk from global governments is there, right? The hit back from the US government and being caught in the crosshairs. How should companies protect themselves in this environment?
I see a lot of multinationals coming to China this year. In fact, I've seen probably more multinational boards and CEOs and executives meeting in China than I've ever seen in my 25-year career at McKinsey. And why are they coming? I think they're coming to kind of see for themselves what's happening here, why they're so competitive, right? And also, obviously, evaluating what's my China strategy. But to your point around the geopolitical risk, I think the bigger risk right now for companies in China is a competitive risk, right? Of course, there's geopolitics, of course, there are challenges. But the fundamental question is, am I even good enough to compete in the Chinese market? And that, I think, is a much more difficult question.
That's a good question, which I also want to ask about, because you look at the German automakers, they used to dominate this market, but now they are not able to compete with the Chinese up-and-coming domestic players. What is the new playbook to succeed for a foreign company in China?
I think it's a million-dollar question, right? In every single category, multinationals are losing market share, especially to Chinese local competitors. In the last 10, 15 years, I think that you have seen Chinese companies in every category getting better, right? Getting better value for money, getting more innovative, and in some ways moving at China's speed. I call that the multinational executives competing against Chinese entrepreneurs, right?
Yeah.
The entrepreneurs have nothing to lose, right? They are all in. They make decisions quicker. They are moving faster. They're more aggressive. They have no hedge, right? The multinational is thinking around, well, like where's China in my priorities, right? How do I want to invest in China and all that? So from a speed perspective, from an aggressiveness perspective, from a innovation perspective, they're a little bit behind. So I think for multinationals, the playbook is, how do you unleash the entrepreneurship within the corporate? Because that's the only way how you compete in China right now, in China's speed.
So what is the best approach? Would you say it's to hire a local team or use a joint venture approach, or how should they come into China?
Well, the most extreme version that we're seeing recently, right, is a little bit how Starbucks and Burger King have been doing. McDonald's did that earlier. Is to say, well, why don't I find a Chinese partner? I can partner with them. I can unleash the management team, right? So I have a sort of PE approach, right, towards how do I get more ownership and more and more decision making to the local team. That's an extreme version. But I don't think everyone has to do that. I do think that there are many structural ways and incentive ways and organizational ways that you can unleash that. But right now, what is very clear is that if you don't find another way to think about China's speed and China competitiveness, you will lose relevance in China. And that, to me, is the biggest risk for multinationals today.
What do you think is the most misunderstood about China right now by global CEOs?
No, I think the most understood right now is around China can be a force for good for your company, for the rest of the world. I think one of the things that is actually very interesting for me, right, is when companies come to China, they look at Chinese companies, they look at what's going on here. You can go back home and be very amazed by what's happening here, and you can go back home and try to do what they do. But I think what people are underestimating is, why don't we think about the Chinese as part of my operations, my supply chain, my lab for innovation, right? China as the lab for your global innovation, right? Is a concept where in the pharmaceutical world, people are doing a lot more, right? 40% of global drugs today are actually, from China, right? And so they're licensing out, right? Some companies right now, I just met a company, very interesting, right? They actually think about their own R&D in China, but they then export that to what they do outside, right? China is not only exporting hard goods, but they're exporting IP, they're exporting methods, they're exporting, different processes outside. That, I think, is a way of progress, right, for many multinationals that I think that they are under-leveraging today.
Let's talk about the Chinese consumer, because they're increasingly sophisticated, but they are less brand conscious, they are less loyal. How should global brands try to get Chinese people to spend?
I think the Chinese consumer is one of the most interesting, fickle, challenging, but increasingly sophisticated customers. I don't think that they are not loyal, but I think they're very adventurous. I think that they are very eager to try new things. And I think that, in China, because the market is so large, so many companies are very willing to give incentive for you to try them. Yeah. So in some ways, I do think that multinationals in China, look, I think that this is actually the forefront of consumer behavior, right? I think this is actually where you get the customers who are very happy to be the first one to try, right? When EVs came out, Chinese consumers are like, okay, let me drive the first EV, right? When the flip phones came up, like, let me try to get the flip phone despite the crease. So I do think that there's a market where for multinationals, you try in China, that can be some insights and innovation they can leverage for the rest of the world. Because Chinese consumers, in many ways, are in some ways moving faster than any consumer group in the rest of the world at scale. Right? Yeah. And that is a great place to experiment, to try new things, to make some mistakes, recover, and do something new again. So I do think that that is a nature, right, of Chinese consumer that could be very beneficial for multinationals.
It's really exciting. 6 months ago in Davos, you talked about how China's growth had exceeded expectations. 6 months later, what's your assessment now?
If we sit here 2 years ago, right, we would be thinking around, is China being more isolated, right? All this geopolitics and all that, right? Is China going to really slow down? We have seen export growing. We've seen more people coming to China. We've seen more companies collaborating in China right now. We've seen AI, more tokens being consumed outside. We've seen now the physical AI, embodied AI, robots and all that, right, being really looked at as one of the best innovations coming out of China. So I do think that, is it exceeding expectations? Well, it depends on what expectations were at the beginning. Yeah,
but
I do think that right now, I do think that China is moving on at a moderate pace that in some ways is meeting expectations, I would say. And I think that we wish the consumption can grow more. I think it will, right? I think that you heard the Premier talk about this as well. I think there are all sorts of ways that the Chinese consumer is now coming back a little bit, in a stable way. I call it the medium growth rate, which I think that we should all be comfortable about.
All right, thank you so much. Fantastic insights. Such great fun talking to you, Joe Ngai. That was the Greater China chairman of McKinsey. Paul.
All right, thanks, Min Min. That's Bloomberg China correspondent Min Min Lo there. Still to come on Inside, PBOC advisor Huang Yiping is going to join us to expand on his warnings that China must provide continuous support for consumers to head off risks to growth. That conversation coming up next.
Most notably, the AI sector has seen explosive growth. Several major AI models have reached new milestones in performance. And our daily token usage has hit several hundred trillion by the end of May, and that ranked first in the world.
Chinese Premier Li Qiang praising his country's accomplishments on AI in a speech at the World Economic Forum in Dalian. He also says the world's second biggest economy is maintaining sound momentum, repeating promises to expand domestic demand. Speaking on the sidelines of the WEF meeting, an advisor to China's central bank says a rebalancing of the domestic economy is a crucial next step to head off risks to growth. Let's get back to Dalian now, where Minmin's standing by with the man who made those comments. Minmin.
Hey, Paul, thanks for having us again. We have Huang Yiping, the PBOC advisor and professor at the National School of Development at Peking University, joining us right now. Dr. Huang, you spoke at a panel yesterday where you really warned against this unbalanced growth in China's economy. What do you think we need to see from the government to really boost domestic consumption right now?
Well, I think it will probably need to focus on two things. The fact that the consumption is relatively weak means the household need to have more income, and they also need to have more confidence. So this is why I think we probably need to push ahead with market-oriented reform to give more income, national income, at the hands of the household. At the same time, we probably need to accelerate our efforts trying to improve the social security system.
We are maybe weeks away from that July Politburo meeting. Are you expecting the government to be injecting further stimulus?
Well, I think if you look at the policy messages in June, we already saw quite a range of the policy efforts from the fiscal policy, monetary policy, the real estate sector, also the new infrastructure investment and so on. So I think the government is already taking efforts trying to stabilize growth, stabilizing the expectation. I certainly would expect the July meeting you just mentioned would certainly further accelerate in that direction.
Do you think what they have announced so far is enough, though? Because last month's retail sales contracted for the first time in years, and that's quite a worrying sign. Goldman Sachs have cut the growth forecast for China this year. Where do you see things going?
Well, weakening consumption is a matter of concern for sure. But the fact that we are seeing negative growth in the total retail sales is partly reflected in the base effect. Last year, we rolled out the trading policies encouraging consumers to buy the electronics and so on. So there was a bigger boost last year, and that effect was not sustainable. So that's why my argument or recommendation is that we should focus on more fundamental measures, like focusing on income and confidence instead of short-term subsidy.
So far, we have heard the government talk a lot about, once again, subsidies, but for the services sector. When it comes to income distribution, it seems like it's not quite enough. We're talking about, 20 yuan for the Yanglaojing, the pension system.
The pension system.
Yeah. Do you think, what is preventing the government from doing more on that front?
Well, I think the policy framework is already here. We're trying to roll out expanding the coverage, number one, of the social protection for not only people in the urban area, but also for these migrant workers, villagers, and so on. That's the first step, and I think it needs to be covered much more broadly. The second thing is we needed to have more funding in that system scheme. And
where is the money going to come from?
Well, the government already had a policy trying to inject the state-owned assets into these social security fund. We have money, but we just needed to do in a much more aggressive fashion.
The fiscal deficit actually shrunk earlier this year. Why do you think the government is cutting spending?
The fiscal deficit officially was not shrinking, 4% of GDP. That's in line with what we call proactive fiscal policy. The issue, I think, is not at the central government level. It's more at the local level because they are burdened with lots of debt problems, and the fiscal revenue is much more constrained. So that, I think, is the problem, that we are not seeing much much more aggressive fiscal expansion. That's an issue we needed to fix.
So how is that going to be addressed? Because property is not really coming back in a big way. How can local governments boost their coffers to spend more?
Well, I think there are two things. Number one is we probably need a more comprehensive restructuring or reconfiguration of the central-local fiscal relations. Because at the moment, what the local government is facing is they have a lot of spending responsibilities, but the revenue is much more constrained. So I think we probably need to realign the system, giving more revenue to the local government. That's the first step. But the second thing, we should also recognize that maybe the local government behavior should change from here. Previously, we relied on local government like investing on infrastructure, large projects, and so on. These were very important. But now we are in a new stage of economic development, relying more on innovation. And I feel that this is time to implement what the government already announced, the policy reform to let market play decisive roles in allocating resources, especially when you want to support innovation. I certainly think local government can still play a role in facilitating innovation, like through industrial policy, but you should only use that industrial policy if you're actually overcoming market failure, not to distort or replace the rules of entrepreneurs or the market.
Right. And innovation needs capital. But right now, last week, the PBOC Governor Pang Gongsheng said that credit growth is not likely to return to the pace of previous years. It's likely to stay, at this level.
Yeah.
So then what's going to drive growth? Will we see a structural downshift in the credit?
Well, there are a couple of things here. Number one is the new innovation probably are not as capital intensive as the previous industries, traditional industry like steel, aluminum, cement, and so on. So they're probably somewhat different. When you look at the new startups, they need smart money. They don't necessarily need bank credit. This is why the second thing we need to look at is the transformation of the financial system.
What do you mean by smart money?
Well, capital markets need to play a bigger role in supporting innovation. We can't rely on bank credit to support innovation because the kind of information asymmetry is quite different when you look at the massive industrial development and the innovation we're talking about, AI, robots, biotech, and so on. They require a lot more efforts and skill in dealing with information asymmetry. We need specialized talents and direct finance channels. So I do think that what we need is not just to boost credit growth, but much more importantly, we need to raise the proportion of direct financing and the VCs and so on in supporting these innovations.
Do you see a rate cut coming this year?
Rate cut could still be on the table, but I'm not particularly sure if that it's something that definitely will happen. The main reason is while we are seeing the inflation rate picking up, although it's still below 2%, so that's not a bigger concern. But I think what we probably will really need is more targeted measures supporting specific sectors, like the innovation, new quality productive force. And hopefully the government can also do something in terms of relanding or structural monetary policy supporting what we call investing in people, not just investing in material products.
I want to ask about the RMB because the fix has been set weaker for the fourth straight day now. And this is coming as the German Chancellor at the G7 raised the issue of currency devaluation. He didn't name China, but it's sort of hinted at. Do you think the Chinese yuan is devalued against the US dollar, the euro?
Well, I think the RMB, by and large, it's a result of market forces. We have an exchange rate regime called managed float. So it's affected, it's determined by the demand and the supply relations. And obviously, the policymakers have some influence on the level of it. The overall goal is that it should be left to the market forces, but avoid very volatile volatile fluctuations in exchange rate. I'm aware that there are many people arguing that the currency is undervalued when they look at the external account surplus, especially trade surplus, which was like around 6% of GDP last year. And that's the basis of from which people arguing that currency is undervalued. However, we should probably look at a more broad picture. When we say the currency is undervalued or overvalued and focusing on the trade balance, that is the case when the financial sector is not open. And that's not the case anymore. If you're seeing like a capital flowing out and flowing in, that is becoming a more important factor determining the level of the exchange rate. And particularly at the time as we start to discuss weakening of the economic growth momentum, and that is a very important factor affecting people's interest in holding the currency.
Thank you so much. Fantastic conversation with you. That was Dr. Huang Yiping, a PBOC advisor and a professor at Peking University. Paul?
All right, thank you. Bloomberg China correspondent Min Lo there. Welcome back. You're watching Insight. Kind of interesting, whippy day on markets. The Kospi's back in positive territory now. It was having a reasonable day, then turned negative. Now we're up by about 1%. It has rebounded somewhat after a 10% slump on Tuesday, but attention for the tech story, at least, turning to Micron earnings now, which are Wednesday US time. We also saw Samsung enjoying a bit of a bounce after the possibility that it may announce a share buyback. But elsewhere on the screen there, you see a whole lot of red. The CSI 300, though, in and the Hang Seng Index, modestly positive territory there. Now, in terms of the AI story, we've just heard from Zhipu, which is understood to be considering a multi-billion-dollar share sale in Hong Kong. This is according to people familiar with the matter. Company understood to be working with advisors on a potential placement that could take place as soon as next month. Zhipu shares up there by a little bit more, or just over now, 8%. The shares have soared 2,000% since listing back in January. In the meantime, let's take a look at the market open in India. Happened in the past few seconds. On Tuesday, Indian stocks fell to their lowest level in a week, and things looking fairly subdued in the early going here on Wednesday. Tech stocks again in India had a bit of a rough ride yesterday. Infosys, TCS slid. We also saw JSW Steel down the most in almost 3 months. Keep an eye on Tata Motors, though, aiming to nearly double sales in India to 1.2 million units by fiscal year 2031. So some modest upside there for the Sensex. The Nifty IT index, meanwhile, better by 0.75%. Now, Bloomberg has been told that Donald Trump Jr. had a private meeting last November with billionaire Gautam Adani while Adani was facing US bribery charges. Last month, the Justice Department moved to drop the charges after Adani agreed to pay $18 million to settle an SEC case. For more, let's go to Mumbai and Bloomberg conglomerates reporter P.R. Sanjay. So, Sanjay, if there are dots to be joined here, can you have a go at joining them for us?
So, thank you, Paul, for having me. This is last November when Donald Trump Jr. had come to attend a private wedding. He had another private meeting, and what we are picking up is that Donald Trump Jr. had a private meeting with Adani family representatives in Ahmedabad, and the key members were present in the meeting. And we were not, could not ascertain what transpired in the meeting. The details and the contours of the discussion were not in the public, and also. This meeting was led by the younger son of Gautam Adani, who is Jeet Adani, who is also director of Adani Airports. And he had also another meeting in Florida with Donald Trump Jr. But again, in both cases, we could not ascertain what transpired, what were the details emerged out of that meeting. But in November, in Ahmedabad, in Gujarat state, there was one meeting, and there's another meeting in the Florida, which is led by Jeet Adani. But we had contacted Donald Trump Jr.'s office also. He said he has nothing to do with this DOJ case, which has been dropped, which has been settled. There were 3 cases which has been dropped. So they clearly said there's nothing to do with these meetings or the settlement.
So we'll be hearing from Gautam Adani later today, giving a speech to the AGM. Can we expect that he's going to address any of these issues, or is he going to take this opportunity to talk about something else?
It's very interesting because today is his 64th birthday, and it's flagship Adani Enterprise shareholders meeting. So he will definitely mention about the details where the settlement happened with the Department of Justice and Security Exchange Commission and OFAC also. But largely it will focus on the company's roadmap, capex, investments, and which will be aligned to the national building goals for all Adani Group companies. Because this speech will be the flagship speech for all Adani Group of companies. So that's what we're expecting. He will definitely touch upon the details on the DOJ, SEC, OFSC settlement issues, but we are not expecting that there will be huge mention about huge focus on that aspect. So.
All right, and subscribers can watch the Adani AGM on Live Go. That kicks off in about an hour's time. Bloomberg Conglomerates reporter PR Sanjay there in Mumbai. Thanks so much. Now, in a world where smart technology is reshaping how we live and work, one company is aiming to be at the centre of this transformation. Tuya Smart is an AI cloud platform that drives the tech behind many consumer smart home devices. Let's get back now to Min Lo at the World Economic Forum meeting in Dalian, China, where she's standing by with the company's co-founder, Min.
Hi again, Paul. Yes, I have with me Alex Yang, the co-founder and COO of Tuya Smart. As you said, this is a company that sells global software and AI cloud platform for the Internet of Things, so providing the technology for other companies to create smart devices. Alex, thanks for joining us today. Since we're in China, let's start with that, right? Given the environment here where we see demand for consumer appliances coming down or slowing down, how much room do you see for growth in your China business?
I think that there are pretty large rooms for the growth of the domestic market in China. The reason being is we found that so interesting is that overall we can say that the resale is kind of slowing down in China. But this high-tech products, especially some new sectors we're approaching, is fast-growing, including like the companions. Recently, this year we launched the products with for Zuzu, so it's companion pad for young ladies, and that's growing quite well. And we found that the user behaviors and the more and more new users that's starting to become heavy, sticky with AI applications.
You have pretty strong revenue over the last few quarters. What is your outlook going forward?
I think that the momentum will continue to grow and continue to grow stronger and stronger. And thanks to two things. The first one is that more and more global users, consumers, they become AI users, no matter through the LLM apps or any different type of AI agent apps. So they get more and more used to, have the experience to directly communicate with the AI. And then starting from there, it's starting to search new applications besides the apps. So those kind of new devices showed up to say that right now I'm content with the AI capabilities that bring their interest.
How are you seeing consumer demand changing, and how is that shaping your product offering right now?
I think that the user behavior is starting to change, and starting with every single age. Like my son, 5-6 years old, and right now he's trying to verify every answer his father answer him's questions. And to say, are you sure about this? Let me verify with my AI. So I think that the entire society is trying to reshaping their skill set and the gateway for them to get the knowledge and on daily basis. So that's the first one. And while market education is trying to get further and further, and people will feel so naturally, seamlessly that they have any other type of products that are coming on with the AI.
So what is your most important market for growth right now?
I think right now we still have the global footprint, so very balanced in different regions. Like the European market right now contribute around 30% of my overall business, North America nearly 20%, and Southeast Asia 16%, Latin America 12%, and China still around 15%, and still have Middle East and Africa, and over 5%. So it's quite diversified and balanced, different region and distributions. But for us is that we need to break down in different region and sectors. Like for European market so far, and so energy sector become more and more important roles in that market. And while in Southeast Asia we found that security and the home security type of the portfolios will play a more important role out there. And for Latin America right now we're searching for entertainment type of portfolios. So different lifestyles in different regions that people will search for different things.
Given the global fragmentation we're seeing, I'm wondering, do you face challenges as a Chinese company trying to get clients in the US?
And I think that there's challenge overall, right? Not recently, but the key part is that the key challenge will come from whether you provide a really competitive technologies that helping the U.S. customers to get a really good product that allow them to fight their own fight. In the same time, that you will be able to deliver the technology in the right way that will bring the confidence of the U.S. Field customers out there.
What do you think is the biggest difference between the U.S. and Chinese market now? How do you have to market and sell your products differently?
I think that there are several different things. The first one is that the lifestyles in two countries are totally different, right? And so how the daily lives looks like in American citizens is totally different than the Chinese people's. So like one use case is the bird feeders. That will be interesting applications we develop for U.S. market after COVID, while people starting to work from home. And so they feel boring that besides the working hours, and then they're starting to be connected with wildlife in the backyard. And then we provide the AI bird feeders to allow them to attract the wild birds and counting birds, and to help them to recognize what species and the knowledge behind the birds. But in China, that remains that doesn't succeed, because people don't live in that way. So the first one, they understand different lifestyles and different regional peoples. And the second one is that to understand different business models. Like for U.S. customers, they more rely on the global supply chain, existing in the past 20 or 30 years. And so the key part for them is the product design, product definitions, and distribution. But in China, maybe not. In China is that they focus more on the manufacturing, supply chain, optimizations, and then marketing.
Yeah.
So that you need to find the right approach to hit the right strengths in different customers in that area.
All right, thank you so much. Great insights. You really have to localize to fit the consumer needs in different regions. That was Alex Yang, the co-founder and COO of Tuya Smart. Paul.
Right, Bloomberg China correspondent Min Lo there in Dalian, China. That is it for Insight. We've got Horizons Middle East and Africa coming up next. Keep it here with us. This is Bloomberg.